All right, so today I wanted to make a video about stocks that I think are too expensive and have been too expensive for at least 2 years. And the reason for that is that that's the amount of time that I've been having a very accurate, well-kept, up-to-date watch list. So getting right into it here, the first one is NVIDIA, and obviously everybody knows what NVIDIA is. It's the second largest company, I believe, or third in the top 3 largest companies in the world. And if you look at NVIDIA right now, they're actually below their 5-year average PE and price to free cash flow, but they're both over 50, and that's just way too expensive, right? I mean, frankly, I don't think I would ever touch a stock that had a PE or a price to free cash flow above 50. That's just way too expensive, especially for a company that's this big. If this was like a 500 million or a $1 billion company, maybe you could justify it, but the amount they're going to have to grow to justify this valuation and still beat the market is pretty outrageous, at least over the long run. So very good company, but still way too expensive. Just off the top of my head, they'd probably have to come down probably 40-50% before I would be interested. Could it happen? Absolutely, but in the near term, I don't expect that. The next one is Arista Networks. This is another stock that I think is a really good quality company. Just hasn't got cheap enough, and it might. This one's a little bit less expensive than NVIDIA, but it's actually above its historical valuation. So way too expensive, but still a phenomenal company. Another not nearly as big as NVIDIA, but this over $100 billion. So something you'll notice here is that these are definitely skew on the larger end. If we're looking at the stock market in general, the area that's the most expensive, and frankly the area that I wouldn't touch of the market right now, is your large cap growth. That's the area that, especially like the mega cap, like we're talking companies over 100 billion or even a trillion. Those are the companies that are really expensive. Like there's virtually none of them that are trading for a fair price right now. Honestly, the only one that I can even think of off the top of my head, at least, that I'm currently buying is ASML. That's the only one I can think of. The next one is Manhattan Associates, another company in the semiconductor or the technology area. This one had a big pullback. I bought it in my mock portfolio. I think it was this pullback back in July or maybe even in May. I think I bought it. I think it was a little over $200 a share. So it was around here. I remember buying 100 shares in the mock portfolio. Another very good company. This one's just under 17 billion, so not nearly as big as the other ones, but still a large cap name. The next one is Badger Meter. This one's a little bit different, but they're in the electrical equipment area. This is an area that I really like. I think there's a lot of growth in this sector. This company just trades extremely expensive, right? 53 PE, 48 price to free cash flow. I really like it. I have it on a watch list, but it's way too expensive. The next one is a company I made a video about very recently, Viva Systems. Really like it, but way too expensive again. A PE of 52, a price of free cash flow of 32. That's not crazy, but still, I think you'd have to come down probably 20 to 30% before I'd be interested here. But another example of a really good company. Palo Alto Networks. This one is definitely on the larger end here, $122 billion. If we look at its valuation, PE 44, price free cash flow 39. This one I don't think has been cheap enough since 2022, just if we're going back here. I mean, they were down around 134 back in April. Honestly, they probably would have been a buy there. They probably would have been well below their averages. I'd have to double check and see, but just based on the numbers here, like I've said, I think anything on over 40 is just outrageous. They're right around that. For a company this large, probably anything over 30 is outrageous. So I'd say they have to come down probably 20%, just ballpark number off the top of my head. Palantir, this company has been one of the best performing companies in the entire market this year. They're up like 300-400%. Let's just see off the top of my head here. This is one I remember looking at like $30 a share. I remember earlier this year looking at it right around there, even in the 20s, being like, I'll buy it if it goes into the teens. Like, so I had buy orders ready to go, and they never failed. And obviously, because it's at $78 a share now, it's up almost 400% this year. I really do like it. Like, I really like this company. Just way too expensive. And frankly, the market disagrees. But a PE of 378, a price of sales of 68, like, they'd have to come down, honestly, probably to, $25, $30 a share. Probably, we're talking 70%, 80% roughly for me to be interested. Maybe $20 a share. Great company, just way too expensive, even compared to pretty much everything on the list here. Monolithic Power Systems. This is a semiconductor name, another phenomenal company, I believe. I don't think they are as expensive, a PE of 68, but they are below their historical valuations on every single metric. But still, way too expensive. Great company. Every one of these I have on a watch list. I do have rough price targets, although I haven't updated most of them in a while. I'll probably have to do that going into the new year. We'll see how things go in the new year. There's a lot of people that are talking about a pullback. I mean, there has been a tiny pullback so far, but we will see. We will see. I think a lot of these companies over the next year or two probably will become viable, but you never know. Lennox International, sorry. This is another one that I'm kicking myself. I was thinking about buying it around like 500 earlier in the year, and it's over 600 now. It was expensive back then, so in hindsight, I think it's the right move. Just because you turned out to be wrong on the share price movement doesn't necessarily mean that it was a bad move. It's not as expensive as the other ones, but it is above its historical valuations, and it is a company that sells air conditioners, essentially. So they're not selling semiconductors or software like these other companies. So too expensive, but I do really like this space. Broadcom. This has been another one of the darling companies out there this year. This is one that I remember buying back in 2022 at like $550 a share, which split adjusted is about $55. I sold it at like $950 at the time, thinking I was a genius, and turns out it still had another over 200% to run. So I think it was the right decision in hindsight. It back even then, back at like what is now $95 a share, it was expensive, and now it's just way too expensive. This is over $1 trillion company now. At the time, it was less than 500 billion. So another example, great company. I just think that they've gotten way too far ahead of themselves. I mean, the PE is almost 200, like way too expensive, right? Way too expensive. The next one is ServiceNow. This is another, again, obviously a software company. Way too expensive. It is a really good company, but I mean, a PE of 166, a price of free cash flow of 66, way too expensive. Although, again, I really do like it. Amphenol, this is a company that I do own in both personal or just in the personal portfolio. It's about 4 to 5%. I bought it back when it would have been below $50 a share because they've split since I bought it. I'm up decently on that. They are well above their historical valuations. Another example of a great company you definitely want to have on a watch list. Every one of these companies definitely is on the watch list. Costco, this is another one that's performed extremely well this year. They are actually one of the top 10 companies. I believe they're roughly number 10 in the NASDAQ, which again, a lot of people probably wouldn't expect a company like this to trade in the NASDAQ, but turns out they do. Great company. I think that they have a very good moat. They're run exceptionally well. I know my local Costco is always extremely busy. Like I'll go on like a weekday morning at like 10, 11 o'clock, and they're crazy busy. Like the average time I go to Costco, they are busier than I've ever seen the local Walmart. So, and the Walmart's if anything, they're in a better area. So, and again, obviously this is anecdotal, but Costco, crazy good, like amazingly good company. This is one I would buy in a heartbeat if it was a good valuation. Way too expensive though. I mean, a PE of 55, a price of free cash flow of 83. This is one we're going to have to wait for, a sizable, probably like a 30% pullback before I would be buying. But nonetheless, it is a great company. Taiwan Semiconductor. They've also performed extremely well this year. They're basically right at an all-time high. They're actually not crazy expensive based on their historical metrics. A PE of 27, a price to free cash flow of about 34. That definitely is expensive, but is it way out of line? No. Like, this is one that probably only has to come down 10 or 15%. I do have pretty much a full position in my personal portfolio, so I probably would not buy. But if I didn't, I probably would. So we're talking probably like 170 to 180 is what I would say is fair value for this company. So they're not that far off. The next one is Dollarama. This is I think it might be one of two Canadian companies I have on the list. This is one that in the mock portfolio, I almost timed the bottom almost perfectly. It bottomed out at about $100 a share earlier this year. This was right around here, actually. Early on in the year, it was in January, it was below $100. But when I started the mock portfolio, it was back in February, and it bottomed out right at about $100 a share, just above. I had a buy order for, I believe it was 100 or 200 shares for $101, and it hits $100.36. So I timed that perfectly. Not something you're going to do very often, but I timed it pretty much perfectly. Again, it's not something you're going to do regularly, but I did do it that time. It is in a little bit of a downtrend, but I mean, you have to keep in mind the market as a whole is in a little bit of a downtrend. They're 7% off their all-time high, but you also have to keep in mind they're up probably 50% on the year. Let's see here. 48%. So this is another example too. Like there's a couple local Dollaramas in the city that I live in. Actually, there's three, but there's only two of them that I've been to on at least enough of a basis to know, and they're almost always moderately busy to very busy. So I think that these thrive in your small to medium-sized cities, and I think that's like Canada's population is growing extremely fast. And I think it's going to be a company like this definitely will benefit from that. So another one that I definitely would have on a watch list. The next one and the last Canadian company that I have on the list is Constellation Software. Great company. I've been talking about it being too expensive for a long time now, probably over a year I've been talking about it. It's ran up a lot since then. I remember talking about it like when it was in like the low 3,000s. Like, yeah, I'm gonna buy it if it goes below 3,000, and it turns out we're at 4,500 now. It is up. It's up nicely on the year, just under 40%. If we look at its valuation, though, it's going to be really expensive. Let's see here. Yeah, PE's over 100. The price of free cash flow is 33. So based on PE, they're crazy expensive. Based on price to free cash flow, they're not. Based on price to sales of under 7, that's not expensive by any means. So just ballpark, I'd say we'd have to come down. I still think we'd have to come down definitely into the 3,000s, probably the mid 3,000s for me to be interested. But this is another example of a really good company that definitely would be a buyer of. But pretty much every company on this list is they're gonna be at a good valuation like every 5 years, maybe even every 10 years. Like you really have to be patient with them. Another one is Microsoft. Obviously, everybody knows what Microsoft is. They've been way too expensive for a long time. I mean, they're currently at a PE of 35, a price to free cash flow of 44. And given how big this company is, you have to be really careful. Like you have to be really careful that these really, really large companies, when they trade at these crazy high valuations, the amount that they have to grow to justify that valuation is a lot harder than a smaller company. Even a smaller large cap company, it's very hard. So you got to be careful with these ones. The next one is MasterCard, and I do own Visa. MasterCard, they're both really good companies. Honestly, you're splitting hairs when you compare them. MasterCard trades at a more of a premium than Visa does. They have grown a little bit faster than Visa over time, but again, we're pretty much splitting hairs. They are actually a little below their historical PE and price to free cash flow, but those are both in the high 30s. I would wait till it went below 30 to buy, so we're talking probably 20% roughly for them to come down before I would be interested. And the last one on the list here is Shopify. This one is way too expensive. This one would have to come down probably more than that. Yeah, I mean, a PE of 101, a price to free cash flow of 97. We're talking probably 30-40% before I'd be interested in them. We're talking maybe $30-40 a share. It would be not quite that much. Maybe we're talking maybe $40 a share roughly. Would be roughly where I would be interested. Another example of a really good company, I think that this is a company that'll do well in the future, but they're just way too expensive, like way too expensive. I mean, and they're over 100 billion market cap. So, I mean, growing into the valuation they're in is going to be pretty tough. So anyway, that is the list. If you liked the video, please like, subscribe, comment, all that good stuff, and stay tuned for more.